Welcome to this explainer. Today, we're diving deep into the recent board outcomes from Fractal Analytics. We're going to break down their FY 2026 moves exactly like a seasoned financial analyst would. Because, if you've ever wondered how a major tech and AI player optimizes its corporate structure while sitting on a literal pile of cash, well, you're in exactly the right place. Let's get right into it.
So think about this. What's the first thing a company actually does after locking in its year-end financials? If management is smart, they trim the fat. And after Fractal's board of directors met on May 11th, 2026, they didn't just pat themselves on the back and approve the standard numbers. No, they initiated a highly strategic corporate diet. We're going to look at exactly which levers management is pulling to position themselves for the future. Here's our roadmap for today. We'll start with the FY26 financial results overview, move into a segment breakdown comparing AI versus alpha, then cover merging Senseforth and Fractal, liquidating Fractal Frontiers, and finally, we'll wrap up with the analyst's verdict. All right, starting with part 1, our FY26 financial results overview. To establish their baseline health, Fractal proudly walked away with an unmodified opinion from their statutory auditors. That is exactly what you want to see. And a massive indicator of their liquidity heading into this reorganization is their cash and cash equivalents. They're sitting at a highly solid 2,067 million INR. To put that into perspective, it tells us they absolutely aren't restructuring out of desperation. Actually, it's the exact opposite. They are operating from a position of profound financial strength. And this really brilliantly illustrates their forward-looking capital allocation strategy. If we look at how they're utilizing their IPO proceeds, they're directing funds to prepay or repay borrowings in Fractal USA, setting up brand new office premises in India, and aggressively investing in R&D and sales under their Fractal Alpha segment. But perhaps most interestingly, they're specifically setting aside funds for inorganic growth through unidentified acquisitions. Seriously, keep that last point in mind because it's going to be crucial by the end of this explainer. Moving right along to part 2, segment breakdown, AI versus alpha. Before we get into the mergers, we really need to understand the micro view. The chief operating decision maker looks at the business through two very distinct lenses. First, there's Fractal.ai, which delivers AI services and software market solutions. Then you have Fractal Alpha, which essentially acts as the engine for R&D, sales, and marketing. Now, while these are distinct segments for financial reporting, the filings make it incredibly clear that they work collaboratively to solve complex client business problems. So they aren't siloed off from one another. They are highly synergistic. Okay, part 3, merging Senseforth and Fractal. Now for the real climax of this filing, the corporate restructuring. But before we announce the fate of Senseforth US, it is absolutely crucial to understand what a step-down subsidiary actually is. Basically, it's a company owned by another subsidiary rather than directly by the parent company. Think of it like a grandchild's company. Having too many of these makes the corporate structure incredibly convoluted, and let's be honest, it keeps corporate lawyers entirely too busy. And that brings us to the board's big decision. They've officially approved the merger of Senseforth Inc., a wholly owned step-down subsidiary, directly into Fractal Analytics Inc., which is a wholly owned materials subsidiary of the parent company. In corporate finance terms, they are literally collapsing a layer of the organizational chart. According to Annexure A of the SEBI filing, this isn't just some administrative housekeeping task to keep the legal team occupied. No. This is a highly calculated operational move explicitly designed to optimize the bottom line. So, what's the analyst-approved reasoning here? Management is intentionally streamlining the corporate group structure. By absorbing Senseforth US directly into Fractal US, they derive immediate operational synergies and achieve administrative and cost efficiencies. But most importantly, they significantly reduce duplicative compliance overheads. I mean, why file 2 sets of complex tax returns and maintain 2 administrative boards when you really only need 1? It is a textbook efficiency play. Which brings us to part 4, liquidating Fractal Frontiers. The restructuring didn't just stop at that Senseforth merger either. The board also formally approved the liquidation of Fractal Frontiers Inc., which was a wholly owned subsidiary of Senseforth AI Research Private Limited, so yet another step-down subsidiary of the company. Basically, management is actively identifying entities that are no longer serving a distinct necessary purpose in the corporate hierarchy, and they're shutting them down to eliminate structural drag. Now, whenever you hear heavy words like liquidation or merger, the market can sometimes get a little spooked. But to reassure any investors or analysts paying attention, the filing explicitly includes this quote, stating the move is designed to enhance operational efficiency without any adverse impact on ongoing business operations. In other words, they are cutting the structural fat, not the operational muscle. Finally, Part 5, the analyst's verdict. So, how do we synthesize all of this raw regulatory data into a clear takeaway? Well, both the Senseforth merger and the Fractal Frontiers liquidation are part of the exact same playbook. As Annexure B explicitly highlights, this represents a broader, sweeping management initiative to ruthlessly eliminate duplicative compliance and administrative overheads across the entire globe. Let's recap the whole picture here. We are looking at a fundamentally healthy company that just got a perfectly clean bill of health from its auditors. They've got strong cash liquidity sitting at 2067 million INR. They have clearly defined and highly collaborative operating segments in AI and Alpha. And right now, we are seeing a management team willing to aggressively eliminate redundant step-down subsidiaries to streamline their legal entity structure for long-term cost efficiency. Which leads us perfectly to the ultimate question you should take away from this explainer. Remember that IPO capital allocation we discussed earlier? The bucket specifically earmarked for funding inorganic growth through acquisitions? Well, now that Fractal Analytics has aggressively leaned out its internal operations, simplified its corporate structure, and sits on robust cash reserves, what bold move or acquisition will they target next? A streamlined predator is a fast predator for sure. Keep your eyes on this space. Thank you so much for joining me for this explainer, and we'll see you next time.